one of the things that's most important for me at Kind Equity Partners is really to educate my passive partners so that you have all the information you need to make an informed decision. So what I'd love to do right now is just go through an investor deck that we did on a previous project. And as you're going through this, I'd like you to pretend as if. What if I was looking at making this investment right now? What are some of the questions I'd have? Because this makes me a better sponsor. Ask your questions now. Let's answer them. Let's add those questions and answers to the frequently asked questions so that we can all be ready and more prepared for when the real investment does come. So we're going to have a cover page. We're going to talk a little bit about why Kind Equity Partners is in this deal. We handle the hassles for you. And then high-level overview about the asset itself. In this case, it's the Azul. It was a 362-unit Class B, Class C complex in Dallas, Texas. And if this was a webinar, I'd read the entire disclaimer to you, but you can read it yourself in the attached PDF. Table of contents. And then a really high-level executive summary about the asset so that you're comfortable knowing just what we're buying. 362 units built in 1983, purchase price a little over $32 million, looking to raise $8.5 million in equity, average unit size, and then what kind of debt we're looking at. And because real estate is a team sport, we want to be really careful about finding the absolute best partners in all the different areas of the country that we invest. And so there's going to be some great information about the sponsorship team and why I've chosen them. Information about yours truly, and then the other asset managers as well. And you can read all the details in the attached PDF. And one of the key team members is the property manager. So there's going to be great information about the particular property manager that we've chosen to run the investment and why we think they're going to be a great fit. And then demographics is incredibly important. We want to make sure that our investments are in high population growth, high job growth areas. So we're going to have a lot of information about the larger metropolitan area right down to the neighborhood. So here the Azul it's in Dallas, Texas. It's in one of the inner rings. Highway 635 rings most of the city of Dallas, and it's right off the freeway. And so for a car-centric community, it's easily accessible. And then great information about the Dallas-Fort Worth market, the major employers who have their headquarters around, lots of information about Dallas. And now we're starting to tighten in on our local neighborhood in Dallas, why we think that the Lake Highlands market is one that has exceptional growth above what the traditional growth in Dallas is. There you can see a picture of the Azul just off the 635 freeway, right at the on-ramp and the exit. Looking at the demographics, what's the 1 mile, 3 mile, 5 mile household income? And then with Dallas at this particular time, we had identified that a lot of the multifamily assets that we were looking at were actually being purchased by institutional investors. And so you're going to see how that plays into our plan for what we want to do with the property. So a little bit more information that the Azul had been owned by a real estate trust. They had done some work, but there was room to improve and make it ready for what's really going to end up being the institutional buyer that buys it from us. And again, the great visibility, the blue on the Azul just pops as you're driving down the freeway. And then information about the amenities at the property, and then the different units that are available. We had 362 units, 80% of them were one bedrooms, but we had a number of different one bedroom layouts so that possible future tenants had lots of options for their layouts. And now we start getting into the specifics on the deal itself. We've already talked about the purchase price, but how does that equate to the dollars per door? How much were we spending per apartment? And then how much are we planning to invest in each apartment moving forward? A couple of things to note here. Regardless who you invest with, you want to make sure that the sponsorship team is investing their dollars right alongside yours. So out of the $8.5 million in equity that we raised, at the time the presentation deck was put together, the sponsorship team was planning on investing 15%. I think we ended up putting in close to 20% of the total equity. And then closing costs, what are those fees that are going to come out of the purchase price? Now we start getting into the business plan. How are we actually going to create value when we own this asset? So there was a number of things that we looked at with the Azul. We were going to take the rents from a certain level. We were going to improve the quality of the units because in many units that hadn't been done for a number of years. And we were going to be able to bump the rent roughly $100 per month per unit. There was a great internet and cable package. I'll talk more about that in a minute. The Azul had alcoves for washers and dryers, and where we could buy washers and dryers and then actually lease them to the tenants. There's great space for spacious backyards. We ended up building those backyards, and we're getting the $75 a month premium that we anticipated. And then there was plans for, and still is plans for, reserve cover parking and uncovered parking. COVID's just put a damper on that. Everybody's staying home and their cars aren't moving, so we can't do much in the parking area. Here's a graphic representation of the fenced backyards, really a highly sought after amenity, and we are getting the $75 a month. I had mentioned the institutional buyers. One of the things we wanted to do was get ready for that institutional buyer. And so an institutional buyer, they want to buy an asset. They want it hassle-free. You know, the term is move-in ready. When you bought a house, if you had small kids, you just wanted a move-in ready home. You did not want a fixer-upper. And so these institutional buyers, they want the same thing. They want all their boxes checked off. And so our business plan was to make sure that we had checked off all those lines for the new buyer. Debt's a little interesting here. Typically, we're going to be using agency debt, which is fixed rate debt, 7 to 12 years, and we know exactly what the interest rate is. When we bought the Azul, it was a unique period in time where many of the agencies had frozen their lending, and we knew that interest rates were dropping. And so we chose to find floating interest rate. We capped how far the rates could go up to minimize our downside, but then we allowed ourselves room for the rates to drop, which they ended up doing. We'll see that in another slide. This is where I pulled together the research from economists from around the country showing that interest rates were expected to drop. So we felt really comfortable over the hold period of the Azul of having low interest rates. And that's proven out to be very much the case. And there are significant tax advantages for buying real estate. I'll let you and your tax professional talk about the implications for investing in real estate on your particular taxes. But I know for me as a real estate professional, running a construction company, investing in real estate as my primary business, there are very good advantages. I'm happy to talk about how we can help get you set up as a real estate professional as well, if that's at all of interest to you. And then the exit strategy. Check the boxes, be ready for the institutional buyer, and aggressively do our work. Use our two sponsors who run construction companies, really lean into the business plan, make sure that the work is done quickly in 24 to 36 months, so we're ready to sell. When we look at exit strategy, there's a term called cap rate, it's a fancy term. I would ask you to look at it find it in the frequently asked questions where I can go into more detail. But basically, the higher the cap rate, the lower the price that we're going to get. And so to make sure that we're using very conservative assumptions from the price that we purchased, from the cap rate that we purchased the Azul at, we added quite a bit to what's known as our reversion cap rate, what we thought we were going to sell the Azul for, which lowers the price, it lowers our return, it lowers expectations. So under promise and over deliver. Here's the information from our property manager on what we were planning to get in rents. I'll do another video on how we're actually doing during COVID and the great freeze of 2021. It's been interesting. And then where the cap rate and the rents were in the Lake Highlands submarket and where they were projected to be in the future. Now we get into the nuts and the bolts of the business plan. This is the underwriting. This is the spreadsheet. I won't hold it against you if your eyes glaze back into the back of your head. Just a couple of things to note. The yellow in the middle of the page, that's our 5-year anticipated total return with that conservative reversion cap rate, or cap rate when we sell the property, and what kind of cash flow we're anticipating each year while we're holding the property. On the left-hand side, you can see our purchase price, just over $32 million, our rehab of $2.5 million, so our total all-in cost of $35 million, and how that equates per door. We bought the Azul at $89,400 per door. We put in $7,200 in rehab, and so our total all-in cost is $96,616. Information about our debt. And then in the upper right-hand corner, there's our unit mix. There's all the one bedrooms. And then there's also the rents when we purchased the property and the rents that we're hoping to get after we've done the rehabs. We don't just want to look at how the rents are going to perform in the first year. Once we've done the rehabs, then we want to actually take a look at how the rents are going to perform over future years. So you can see the upper lines of the spreadsheet. We're anticipating very small rent increases, 3% in year 2, and then dropping down to 2%. And on one of the earlier slides, we actually had projections of rent increases in Dallas of 4 to 6%, and in the Lake Highlands market, a similar 5 to 7% range. So 2% is quite conservative. And then we also want to look at if we were to sell the project at any point during the hold period, so at the end of year 1, year 2, year 3, what could we actually sell the project for based on the net operating income, the cash flow from the property, and how does that equate into a sales price? And then more importantly, how does that equate into return of capital and then a return on capital for our investors? Here's a sample return of capital and then return on capital. The bottom part of the example, in 2019, if $100,000 was invested into the Azul, year 1, year 2, year 3, those are the cash flows that we anticipated from the hold period. And then in year 5, how much do we anticipate returning back to the investor from the sale of the project? So what's the total return to the investor, both from cash flow during the hold as well as the sale? And what we're looking for is we're looking for a high number from cash flow, because what that means is from the typical operations of the property, we want a good percentage of our return to come just in the normal day-to-day operations. We don't want to be reliant on a big return at the end by driving values up and hoping that the market is where we need it to be in order to return capital. So you can see in the upper left-hand corner, we've got the equity multiple of 1.71. So that's simply that $100,000 that was invested in. Over the course of a 5-year hold, we're returning back 1.71 or $171,000 to the investor. This slide is one of my favorites, and this gets a little tricky. So this looks at a couple of things. This is how fast can we execute our business plan? So can we do it in year 3, year 4, year 5? Remember, we did really conservative underwriting for a 5-year hold at a high cap rate, which means a low sales price. So we purchased the property at a 5.8 cap rate, and we're actually planning on selling it at a 6.9 cap rate. Typical underwriting standards say that for every 1 year that you own the property, that you raise your reversion cap rate by 10 basis points or 0.1%. In English, what that means is we bought it at a 5.8, and typical standards are if we think we're going to hold it for 5 years, we should run our numbers that we're actually going to sell it at a cap rate of 6.3, 0.5% higher than 5.8. We actually set our underwriting significantly higher than that at 6.9%. But now we're looking at, 6.9 that's our reasonable underwriting. That 71% gives us that multiple of 1.71. But what happens if cap rates are lower when we choose to sell? And what happens if we sell faster? So you'll see in that green box, that's really where we're targeting our exits. 71 it's still a possibility if we get our achieved rents in the 5-year hold period and the cap rate is at 6.9. The reality of what's happened is much different than that. Rents are significantly higher. The cap rate has compressed quite a bit more than we purchased the property at. On the flip side, we've had some issues with COVID, rent moratoriums, and the Great Freeze of 2021. But that's a fascinating video that I'll do separately. This is just about the assumptions that we have. So this is actually a great example. We've got all these assumptions for should something hit the fan, and oh my gosh, COVID qualifies as something hitting the fan. How can we execute our business plan, and how safe are we making sure we're not losing our investors' principal and then getting a return back on that principal? This is a great slide to share. I love what's circled here. Investors get the first 7% return before the sponsors get a dime. We felt so comfortable in our business plan for the Azul that rather than split cash flows from the very beginning, we wanted to make sure that investors got the first 7% of every dollar that came in. So as rents came in and after we paid our expenses, the first 7% goes to the investors. And then the rest of the page talks about how do we split the cash flows, 20% going to the sponsors, 80% going to the passive investors, and what kind of distributions do we anticipate giving each year. For this project, we planned on doing quarterly distributions starting 6 months after the purchase. Every project is going to be a little different. Some are going to be monthly distributions. Some might be paying immediately. Some might actually wait 9 or 12 months before they begin paying. And that's just to accumulate enough cash so that the property has the operating cash flow to make sure that it can go through the typical business cycles, the ups and downs of managing a business. And then a slide on the fees. Here's our 80-20 split. So 80% of the cash flows and the proceeds after return of capital go to the investors, 20% go to the sponsors for handling the hassle of managing the property. The buyer's brokerage fee, $65,000. That's to the real estate agent that represented us in the purchase. We paid a 1% fee for our loan. The acquisition fee of 0.5%. This is reimbursement to the sponsors for all the time and effort into looking at hundreds of different properties and going through then the due diligence to make sure that this is the right project for us. Property management fee paid to our property manager at Citygate, 3%, and then a 2% fee, the asset management fee paid to the sponsors for managing the monthly hassles of the investment. Typically, there may be a construction management fee because two of the sponsors, we own and manage construction companies. We thought this was a great service that we could give to our passive investors, and we are not charging a management fee. A refinance fee or a disposition fee. So this is going to be an either or fee. I recognize that it's hidden by my head, but on the PDF, you can see the green line is a refinance fee and the white line is a disposition fee. This is at the end of the hold period. There will be a 1% fee paid to the sponsors for either restructuring the debt or going through the sale of the property. Here's the timeline of the investment. When we executed our contract, the time that we had for our due diligence, think of that like our inspection time. And on a 362 unit, you can imagine that there's quite a bit of inspection time. So we had almost a month to do our inspections. And then when we anticipated closing the property, finalizing the purchase of the property, we did end up using a couple of extensions. And so we ended up closing in early December of 2019. Well, that's it. Congratulations. You've made it through your first investor presentation deck. I'm so proud of you. So I'm sure that you've probably got questions. Oh my gosh, what's that? How does that work? Go ahead and write all those questions down. It's actually easiest if you just make a note and say, hey, on page this, I've got this question. Go ahead and email them in. I'll make sure and answer them. And then we can create a frequently asked questions that people have of this particular presentation deck so that we can be ready for future investments. Thanks for taking the time.